Good afternoon. Hope you're okay on this very hot day. I'm going to get cracking in a minute because we've got a lot to get through. So this is for LM1, what you need to know. There's quite a lot of content to go through, so I'll try and condense it into an hour. Might go a little bit over. If we do, you can stick with me, or we will be recording this and popping it on YouTube, and it will be fully available for you for a few days. So LM1, what you need to know. We'll cover, well, what you need to know and the main key points from the book. So we're going to get straight into chapter 1. So fundamental principles of insurance. So the book talks about risk. We talk about risk in insurance quite a lot. And the term risk can be used in many ways across the insurance market. And this is the actual technical definition of risk. So the possibility of something unfortunate happening, doubt concerning a situation and how a situation might turn out, unpredictability, possibility of a loss, and the chance that there might be a gain. So underwriters might use the word risk to refer to the thing that they're insuring, or an underwriter might ask, are we on risk for this? So there's a few different ways that you might hear that word being used. And insurance is known as a risk transfer mechanism. And what this means is that you pay a premium for the transfer of a risk or a loss to the insurers. And the insurers take the premiums of the many, collect those into something called the common pool, which is for all the premiums, and then they pay out the losses of the few out of that pool. And we always have to make sure that in that pool, everyone is paid in a fair premium, an equitable premium. So you only pay for the risks that you bring. Everybody doesn't pay the same. Yeah? So we all have different attitudes to risk. Some people are risk seekers. They might like throwing themselves out of planes, climbing up big mountains. And some people are more happily just being at home, and they're called risk averse people. They would rather not do something like that. And each insurer actually has its own risk appetite. Insurers have the risks that they really like to write. And on the other hand, they also have the risks that they really don't want to write as well. So that's something called a risk appetite. Okay. So the concept of risk management is a key focus across a lot of companies. You may have heard it in the business that you work in. So there's 3 aspects that make up the management of risks. So the first thing is the identification of the risks. So this is where we find out what it is that's posing a threat. And secondly, we've got the analysis of the risks. So we look at how it operates, how often it happens. And then finally, we've got the control of the risks. So what we're going to do to try and minimize it or potentially eliminate the risks. And we can control or eliminate risks through 2 different controls. So the first is through a physical control. So that would be fitting an alarm or putting a lock on your door. And the second is through financial controls, which could be as simple as purchasing insurance to ensure that there's a backup just in case something goes wrong. Okay, so there's 2 bodies that you probably need to know about, which can aid insurers with their risk management controls. So we've got the BRE, the Building Research Establishment. They look at the built environment and offer training and guidance on building materials and construction. And then we've got the FPA, which is the Fire Protection Association. They are the UK's National Fire Safety Organisation, and they offer advice and training on fire control. So they're worth knowing. So we've got here 3 main components of risk. So firstly, just let some people in. There we go. Firstly, we've got uncertainty as a component of risk. So we don't know what's going to happen. We don't know when it's going to happen, and we don't even know if it's going to happen. Let me just, if you could put yourself on mute, that'd be great. Thanks. So secondly is what level of risk have we got? So it's the frequency, how often something happens, and then we've got the severity, which is if it does happen, how bad is it going to be when it does? So if we think about this in a common thing, so parking at the supermarket, yeah, the chances of your wing mirror being clipped are very high. It's high frequency, but how bad it would be is quite low severity. Yeah, but then on the other side of the scale, if we think about something like a plane crash, thankfully these don't happen very often at all. So when they do, they're very low frequency because they don't happen very often. But when they do happen, they cause a lot of damage, aircraft, passengers, property. So it's very extremely high severity. Okay. And then we can also have things that are high frequency and high severity. So this could be maybe a hurricane. That obviously depends on where it is. And as an insurance market, we can really prepare for this because we know when hurricane season is and what certain times of the year that happens, and we can prepare for those eventualities. And next we've got perils and hazards. So a peril is the primary cause of a loss. So we're thinking about the fire or the flood or the theft that's happened. And a hazard determines how the peril develops and influences the operation of it. And we can also split hazards, again, into good hazards or poor hazards. And we can split them into physical hazards. So tangible things like the construction of a building, or moral hazards, which relates to the characteristics and the behaviour of the insured. So is that person dishonest? Are they a criminal? All of these things will be considered by an underwriter. So we've got 6 categories of risk. So firstly, we've got the financial and non-financial risks. So for a risk to be insurable, it has to have a financial value attached to it. So this is the value of a property or the compensation to be paid for an injury. And non-financial is uninsurable because there's no financial value that can be attached to it. So this is like the loss of enjoyment of a holiday. You can't make a claim against that. Or move into a different area so that your child gets into a preferred school. You can't insure yourself if they don't get into the school. We can't put a financial value on that, so it's uninsurable. Next, we've got pure and speculative risks. Pure risks are insurable. This is where there is a possibility of a loss, but not of a gain. You could also break even as well if a claim is met in full by your insurers, but more often than not, you are going to pay an excess, so you probably will be worse off. The opposite is uninsurable, and that's a speculative risk. This is like gambling. So as there is a possibility to make a gain, like if I insured my business against it failing, I can't do that because I would have no motivation to make my business work because I've got it insured. I can just claim it back. So we can't insure those types of risks. And then finally, we've got particular and fundamental. So particular risks are insurable because they are localized in their cause and effect, and they only affect a very small area or group of people. And then we've got the opposite, fundamental risks. They are vast in scale, widespread, things like war and famine. We can't control it. So they're uninsurable risks. And we also need to consider that for something to be insurable, it has to be fortuitous. So it has to be unforeseen. It can't be a deliberate act, okay? There also has to be a legal relationship between the person who's insuring it and the thing that they're insuring, and that's called insurable interest. So also, risks cannot go against public policy or be illegal. So for example, you can't insure yourself against getting a speeding ticket because everyone would just be whizzing around everywhere. It wouldn't be very safe. That would be against public policy because it's an illegal activity. Okay, so we mentioned in the first slide about that pooling of risks, about that common pool. So when people pay their premiums, they all go into a pool. I like to think of a big swimming pool full of money. So everyone has to put in their fair premium for the risk that they bring to the pool. So for example, a driver with a clean driving license who drives a modest car would pay less than a driver with loads of points on their license for speeding and drives a sports car, for example, because it's more likely that that second driver is going to make a claim. So it's only fair that they pay in more. So that's called an equitable premium. And insurers can use the law of large numbers to predict claims as well.